Hello and welcome to another edition of our Financials Financial Forum. Um, Today we'll get started with our markets in motion. Jeffrey's going to lead us off there. So, Jeffrey, if you will, without further ado, get us started with markets in motion this week.
Mhm. So welcome to this week's markets in motion as usual. And then despite another volatile summer week marred by mixed corporate earnings reports and a closely watched Federal Reserve meeting, markets ultimately moved higher. Investors navigated uncertainty around interest rates, inflation, and technology sector spending. The strong performance from large cap technology companies helped drive gains across major indexes. For the week, the S&P 500 advanced up a little bit over 1%, so 1.05%. The Dow Jones Industrial Average gained also a little over 1%, 1.04. And then the NASDAQ Composite led with a 1.59% increase. International equities also delivered solid results with the index raising 2.13%. Yeah, then we got technology stocks remain at the center of investor attention. Early in the week, semiconductor companies faced pressure as investors digested concerns about increased competition and raising AI-related capital expenditures. Excuse me. However, sentiment improved significantly later in the week as investors looked beyond near-term spending concerns and focused on the long-term growth opportunities associated with artificial intelligence. That should help fuel a strong rebound in both semiconductor and large cap technology shares. So another key market driver was the Federal Reserve decision to leave interest rates unchanged. While the move was widely expected, investors closely analyzed the Fed's commentary for clues about future policy direction. Some market participants expressed concern that inflation remains persistent and that the Fed may need to maintain a cautious stance for longer than previously anticipated. As a result, expectations for future rate moves continue to evolve with each new economic data release.
Yeah, so this environment kind of highlights an important reality that we're seeing. The markets are transitioning from a period driven largely by monetary policy to one increasingly influenced by corporate execution, earnings, growth, and capital investment decisions. So, as companies continue to invest heavily in artificial intelligence, investors will be evaluating which organizations can convert those expenditures into sustainable revenue growth, stronger cash flows, and enhanced shareholder value. While short-term volatility remains elevated, the market's resilience has been noteworthy. Strong corporate balance sheets, a healthy labor market, and continued innovation across key sectors have helped support investor confidence, despite the ongoing uncertainties surrounding inflation and interest rates. So, our key takeaways: markets continue to reward long term growth opportunities. Investors remain focused on companies with strong competitive advantages and the ability to capitalize on secular trends such as artificial intelligence. Federal Reserve policy remains a key variable. Interest rate, expectations can shift quickly as new inflation and employment data emerge, making diversification and portfolio discipline especially important. Technology leadership remains influential. While AI related spending has raised questions about near term profitability, investors continue to view innovation as a significant long term driver of earnings growth and focus on the long term, not the headlines. So, market volatility tied to earnings reports, Fed decisions, and economic data releases are normal. Successful wealth management strategies are built around long term objectives rather than short term market reactions. So, looking ahead, we'll be closely watching a busy slate of economic reports, including manufacturing activity, job openings, and Friday's employment report. These releases will help shape expectations for inflation, economic growth, and the Federal Reserve's path forward as markets move through the remainder of the summer. So now let's pivot on over to the Wealth Wisdom Workshop, where today we're talking again about market volatility and why it's more dangerous in retirement than during your working years.
hmm So let's begin with another simple question. Why have you spent years saving, investing, and preparing for retirement? For most people, the goal isn't to beat the market, not to out is not to outperform an index, it's not to accumulate a certain dollar amount. The goal is freedom. The freedom to spend more time with your family, the freedom to choose whether you work, not because you have to, but because you want to. The freedom to travel, pursue hobbies, make memories, support loved ones, and enjoy the experiences you worked so hard to create. In short, people don't want a portfolio, they want a lifestyle. And one of the greatest threats to that lifestyle is market volatility. Today, we're going to explore why market volatility affects retirees differently than workers, and why it can dramatically alter retirement outcomes, and then most importantly, whether your current strategy is prepared to withstand it.
So, one of the biggest misconceptions investors have is that volatility itself is the problem. The truth is that volatility is normal. Markets have always gone up and down. Corrections happen, bear markets happen, recessions happen. So, as investors, we know that volatility is simply part of the journey. But here's the critical distinction: the moment you retire, the consequences of volatility change. While you're working, volatility can actually be your friend. You're continuing to earn income, you're continuing to contribute to retirement accounts, you have years or decades for markets to recover. Time is on your side. But once retirement begins, that equation changes completely. You're no longer adding money, you're actually taking money out. You're no longer dependent on a paycheck, you're depending on your portfolio. And that's when volatility becomes a much greater threat.
hmm So, obstacle number one, the double hit of retirement. The first danger is what many experts refer as a double hit. Imagine your portfolio experiences a significant decline. If you're still working, you simply leave it alone and continue contributing. But in retirement, something different happens. Your account value declines because of market losses. At the same time, you still need income to pay bills, buy groceries, travel, and maintain your lifestyle. So now you're withdrawing money from an account that's already shrinking. Not only is the balance lower, but every dollar withdrawn can no longer participate in the eventual recovery. The combination of market losses and ongoing withdrawals is one of the biggest and most dangerous forces in retirement planning. Obstacle number two, you can't simply just wait it out. When you're 35 years old, a market downturn is frustrating. When you're 75 years old, it can be life changing. Younger investors can often wait years for a recovery. Retirees don't always have that luxury. Bills continue to arrive, income needs continue, withdrawals continue. The market may recover eventually, but the retiree may already have sold assets at a depressed value to fund their lifestyle. So retirement creates a finite recovery window where every year matters, every withdrawal matters, and that's what makes volatility structurally more dangerous in retirement than during your working years.
Another challenge is that volatility isn't going away. So, over the past 2 decades, investors
Mhm.
have experienced major recessions, financial crises, pandemic driven market shocks, inflation spikes, geopolitical uncertainty, and rapid interest rate changes. Markets today often move faster than at any point in history. Information travels instantly, investor sentiment shifts rapidly, and market reactions can be swift and severe. The reality is that volatility is no longer the exception. It's the environment retirees must navigate. Perhaps the greatest danger is that volatility rarely acts alone, though. It amplifies every other retirement risk. If the market declines, longevity risk becomes greater because your money has farther to stretch. Healthcare expenses become harder to absorb. Inflation becomes more painful. Taxes may become more difficult to manage. And perhaps most overlooked, emotional decision making becomes a significant threat. Fear causes people to abandon long term plans. They sell when they should be patient. They make decisions based on headlines rather than strategy. Volatility has the ability to turn small weaknesses into major problems.
Yeah. So the gap we often see is that many people enter retirement using the same strategy they use while accumulating wealth. But accumulation and distribution are very different challenges. Many retirement plans are built around one portfolio, one withdrawal strategy, and one assumption that markets will cooperate. The problem is that retirement doesn't occur in the averages. Retirement occurs in real time with real expenses, real market downturns, and real surprises. A plan based on historical averages may look great on paper, but retirement isn't lived on paper. It's lived through actual market conditions, and that's where many traditional plans are exposed.
Many retirees assume the safest approach is simply to stay the course and hope everything works out. But hope is not a strategy. Ignoring volatility doesn't remove the risk. If anything, it increases it. Without a plan to address market downturns, withdrawals may become unsustainable, portfolio depletion may accelerate, lifestyle choices may become limited, family goals may be compromised, future opportunities may be sacrificed. The cost of inaction is often invisible at first, but over time, it can have a profound impact on your retirement incomes or outcomes, that is.
Hmm. And so, as we wrap up this discussion, I'd like you to think about again what retirement means to you, the vacation you want to take, the memories you want to create, the causes you want to support, the family members you want to help, the lifestyle you work decades to achieve. Then consider this: how much of that future depends on your portfolio generating reliable income? And if market volatility is inevitable, and history tells us it is, does your current strategy have a plan for when the next downturn arrives? Not if it arrives, when it arrives. Because retirement isn't about predicting markets, it's about preparing for them. And the question I want to leave you with is this: is your current path designed to withstand the volatility between where you are today and where you ultimately want to go? Because market volatility is inevitable. The real question is whether your retirement plan is built to survive it. And I think that wraps us up, Marcus, with today's Wealth Wisdom Workshop.
All right. Now, we'll wrap up another segment of For Our Financials Financial Forum. We'll see everyone next week. Thanks.